Welcome to the Real Estate Reserve Podcast with your hosts, Jason Balin and Ian Horowitz.
Ian, what's up, man? Happy Wednesday.
Well, what's up, brother? How
Today Wednesday? What'd you say?
How am I looking? It's all got to come off in 2 days.
Say, look like a caveman. What's that? A week's worth of shaving?
Yeah,
or non-shaving?
Yeah, I got my Corona filter right here under my nose. I'm ready to go. So
doing it big. Welcome to the Real Estate Reserve Podcast. If this is the first time tuning in, welcome. If you've been a regular on the show weekly, thanks for coming back. Feel free to share your experiences with others. We talk everything related to real estate investing on this live show that we do at least a week, sometimes multiple times a week. Today, we are talking about insurance. Now, if you're a new real estate investor, insurance might not be the sexiest topic for you, although it should be. But if you're an experienced real estate investor like myself and like Ian, insurance is sexy. It's something that we think about on a regular basis, not only because we're writing 5, maybe 6-figure checks to insurance companies on a yearly basis, but also to ensure that we have the right insurance in place for our correct projects. If you're fixing and flipping, if you're owning rental properties, multifamily, commercial, some sort of just creative insurance policy in general, it's important to really, really understand insurance. The last thing you want to happen is have the wrong insurance policy in place that you've been paying good money for, and then all of a sudden, an incident happens and you realize you didn't have the right insurance policy in place and you're not covered. So it's important to have the right insurance broker, insurance carrier, the right insurance. I mean, I can tell you from experience that we've been involved in a lot of insurance claims. Insurance claims where we, $1 million policy claims where we've had to go after insurance companies. There wasn't proper insurance covered. So I mean, I've got tons of horror stories on that if you ever want to hear that in the future. So the important part is just really, really understanding and making sure you have the right insurance in place. And tune in with us here for the next 30 minutes or so, just to at least understand the basics, so you understand what insurance policy you should have for your next real estate project.
Yeah, I can tell this subject's near and dear to your heart because you covered it all in one shot. But from our aspect of from doing deals and being the operator and the sponsor of deals, it becomes troublesome sometimes. It's you're stroking these checks, and just like I'm a fireman full time for the city, we're the city's insurance policy, but yet they don't want to pay us, but yet we're the ones out here working, and that's the same thing with your insurance policy. And sometimes it can be difficult. I know we beat brokers up. I'm super excited though to bring in Ryan from Red Rabbit Insurance. Mostly because he's not wearing a suit. We finally found an insurance agent that's not wearing a suit, down to earth. And let's get right down to the basics of insurance and see what it looks like.
Ryan, how are you, man?
Hey, pretty good, guys. How about yourselves?
Doing great. Well, why don't we just start off real quick? Just tell everybody a little bit about yourself and kind of a little bit about your insurance agency.
Yeah, absolutely. So Ryan Daubert, obviously, an insurance agency owner is Red Rabbit Insurance. Kind of specialize working with real estate investors. I'd say that's probably 70 to 80% of our book of business. Also a real estate investor myself, so kind of some unique firsthand knowledge into what it's important for real estate investors to cover and what should be listed in the policy, et cetera. My background, I did this right out of college. Founded my own agency, worked for another agency for about 8 months and founded my own. Started from scratch, no carrier appointments, and kind of built my client base from there. And now we specialize in partnering with real estate investors, property management companies, realtors, et cetera. And so we're 100% referral based, and we like to stay that way, and try to grow our business that way.
So let's start from the basics related to just a regular kind of like the 101 insurance policy that a regular real estate investor would need. So let's say, and obviously there's different policies, but let's say they're either a fix and flipper, right? They're buying a property, renovate and flip, or they're buying a 1-unit rental property. Something really basic, like what type of policy is recommended for buildings like that?
Sure. So you can break it up a couple different ways. So anything that someone's buying, it's unoccupied, they just plan on renovating it and maybe having it eventually be occupied or just flipping it, selling it. We would put that on what's called like a builder's risk policy form. They're very specifically written for the purchase price plus whatever you're spending on renovations, specifically for no tenants living there. The other side of that would be an occupied policy, and that really depends on the size of the property as to what we'd recommend. Generally, like up to like a 1 to 4 family home would be on a dwelling fire policy. Obviously, covers a lot more than fire, which we can get into then, but that's just a legal name for them. Anything that's 3 or 4 units and certainly bigger, any kind of mixed usage occupancy, like if it's a apartment building on top of a hair salon. Any kind of mixed usage where it's commercial and personal tenants, that's going to be on a business owner's policy form, which is a commercial policy form.
Got it. And do you recommend that these investors are also getting some sort of liability policy with this?
Yeah. So generally, most, just about every policy is going to have a liability component to it. The renovations policies, you can go up to $1 million typically. Business owners policies, the commercial policy form, usually they'll start at $1 million. And then individual policies like the dwelling fires, those, depending on the carrier, might be $300,000 to $1 million. For the individual ones, we'll generally recommend the owners get in a liability umbrella policy, which is essentially just additional liability insurance that sits on top of the underlying policies. But kind of what a lot of people don't, I guess, really go over with umbrella products is there's not a lot of liability coming from the tenant side where you're going to get to a 6 or certainly a 7-figure claim. As a real estate investor, you really have to be operating incredibly negligent. The example I give is like there'd have to be a 4-foot hole in the floor. Tenants telling me about it for months. No one ever does anything. Finally, someone falls through. Like that's a gross negligence where you could really see 6 or 7-figure claims, but generally slip and fall claims on snow and ice, $15,000 to $30,000. So they really don't settle for very much. But kind of on the opposite side is auto insurance claims. Those commonly can get into 6 figures if someone's injured or God forbid killed. And so even if you're doing everything right from an investor standpoint, putting everything in an LLC, diversifying your own corporations, what have you, if you get sued personally, those are still just business assets for you and more easily available to creditors than like your primary home. So we kind of recommend umbrella policies that kind of cover that backdoor liability is what we call it, which is you doing something personally and then that potentially affecting your rental portfolio. So that's really the
Gotcha.
We feel coverage.
No, that makes a lot of sense. And how much would you say ballpark median housing price neighborhoods? How much do these policies cost? Let's just say on a yearly basis, just average. Obviously, it obviously differs. And also, how much coverage is usually recommended? Is it replacement costs? I know a lender might have a different requirement than the owner of the property, but like what's usually recommended for
Sure. So first and foremost, always replacement costs. We always recommend replacement costs to our clients. 10, 15 years ago, pricing was drastically different between replacement costs and actual cash value policies. And for the listeners who aren't familiar, actual cash value, those policies are written for market value minus depreciation. So it doesn't matter what number is listed for dwelling coverage. It could be $1 million. The actual cash value is market value minus depreciation. So in that example, if you're paying for $1 million in coverage, but you bought the house for $100,000 and it's 15, 20 years old, they'll take that $100,000 and depreciate it. So you'll be left with not enough to rebuild or repair, and certainly not enough to go buy something else. So we always recommend the replacement cost, which is regardless, doesn't have anything to do with the market value. It's what the carrier estimates it would cost to rebuild the home or the structure exactly like it stands, just brand new. So if it's solid plaster or solid masonry construction plaster walls, the carrier has to rebuild that with no deduction for depreciation. So A lot of times with real estate investors, most markets, you'll see that replacement cost is probably a lot more than what you paid for the property. But it's important to have that because you're obligating the carrier contractually to perform. Whereas with an actual cash value policy, you're relieving the adjuster's hands and how they're feeling that day to determine what the fair market value for your home is and then what they're going to add in for depreciation. So certainly replacement cost without question.
And we'll get into payouts later about how having reputable insurance companies backing you is super important. Jason actually has a firsthand experience with that. And I do want to say, Vadim, had it not been for you, we would have never met Ryan. Not only Ryan was able to provide us huge cost savings to our rental portfolio, but it also comes down to the condition of our properties and everything else. You were talking about replacement costs, and I think this is where guys like me who are out here operating and doing deals, it becomes difficult because when you look at a rebuild cost of $175 a foot, you're like, there's no way. We don't even come close to that. And it's, we've bought fire damaged houses. I guess how as a real estate investor, can you combat that? And, is it a dollar for dollar back out to your policy? And then also you want to talk about, it's not errors and omissions. When you get new codes come in place because you had a total loss, you know what I'm talking about. In your policy. Yeah,
so generally the replacement cost is going to be calculated at the carrier level with specific inputs from the agent side. And a lot of time it's public data sources that pull the square footage, type of construction, year of construction.
Looks like Ryan froze up, so he'll come back here in a second.
Did I lose you guys there for a sec?
Yeah. Go ahead.
Got it. So I don't know where I trailed off there, but basically each individual carrier is going to run their replacement cost calculation based off of square footage, type of construction, et cetera. And then as the agent, we have some freedom to go in there as well and update if we need to. If they're pulling that it's plaster walls, but it's been rehabbed, we can change that to drywall or whatever the construction might be to come up with an accurate figure. So it will vary by market too. If we're looking at something on the Gulf Coast, it might be the same house in Pennsylvania might be $300,000 for replacement cost. Of Gulf Coast might be $150,000. So it will vary by the market that you're in. And then also the carriers are going to run it a little bit differently too. It should generally be in the same range. If one carrier estimating $200,000 for replacement cost, one might be $180,000, one might be $215,000. They should be in that kind of same general range because there's going to be a little bit different how they calculate it between markets.
Yeah, and you're talking about replacement costs and fires and damages. We all look at insurance. It's you pay it every month, and God forbid something happens, and it becomes tough sometimes. You're like, what am I paying for? Especially guys like us who we just go out and fix the stuff 9 times out of 10. I guess can you comment to being a good real estate investor and utilizing your insurance policy versus not utilizing it? Because we hear a lot of guys oh, that's broken, I'll just call my insurance company. They're not your repair company, right?
Yeah, insurance isn't designed to be a replacement for maintenance. If your roof's 30 years old, it's kind of on the property owner to repair that or replace it when it's reached the end of its useful life. And unfortunately, not everyone views their insurance that way, and you'll see a lot of kind of small dollar claims come through, and ultimately that just makes insurance more costly for everyone. But generally speaking, insurance shouldn't be a replacement for those minor maintenance items. It at its core was designed to prevent catastrophic financial losses from occurring. So if your house burned down and it's a $200,000 loss, it's a lot different than a piece of siding that blew off that's $2,000. So generally, we'll kind of advise our clients to use their insurance responsibly, and it's ultimately beneficial to them. So we'll always recommend certainly no lower than $1,000 deductible. In a lot of cases, especially for real estate investors, $2,500 and up. And even with, say, $1,000 deductible, if a piece of siding blows off your house and it's $1,500, it's something that's covered by insurance, but ultimately you're going to have an adjuster go out. You have to meet with the adjuster. you're going to get a $500 check once you pay your $1,000 deductible, and then you just put a claim on your record, which can increase your premiums for up to the next 5 years. So certainly for real estate investors, when you have more than one property, you don't want to have a kind of a dirty claim record for minor occurrences, essentially, because it's just going to jack your insurance premiums up for the next 5 years, if not more. Also, it can even impact eligibility. Some companies don't look at the number of rental properties you have; they just look at the number of claims that are associated with your with your specific entity or your individual name. And if you're over, X amount of claims, they might not even write you, regardless if, you have 200 rental properties and you had 2 claims, that's a kick out factor for some companies. So you always kind of want to make sure you're using your coverage, not for like ding and dents, essentially kind of what we call it, but more catastrophic occurrences that, would be more difficult to financially recover from, without insurance.
Right. And then that all makes sense. And I know we've had a lot of this same conversation because like insurance is one of those markets where you just can't go Google it and be like, this is how it's supposed to go down, right? Like it's kind of tough because everyone has their own opinion on it, what it looks like. Before we get into master policies versus individual policies, I do want to stop and talk about where we are here locally in Baltimore and you right here in Maryland. We have a lot of row houses or townhomes, whatever the heck you guys want to call them. What does that look like when you're looking at your policy, either as the affected or you're the one that has affected your neighbors? Like, what does your policy do or not do for you? Say you had a fire in your unit and it spreads to your neighbors. What's your coverage look like?
Yep. So you're only can insure the property that you own. So if you have a fire and it damages your neighbor's house, that would be actually claimed on their policy, and vice versa. If they have a fire and it affects your property, your own insurance covered pays your own claims. So kind of a funny story. We had a client, and their house was on like the top of a hill, and there was some kind of issue with their drainage, and water was coming off their roof and flowing down the hill and inundating their neighbor's basement. And their neighbor got upset with them because they said, hey, it's your water issue. It should be on your policy. And, of course, the carrier said, no, it's we're not, our policy for our house isn't responsible for covering our neighbor's home. So, and that's all encompassed in the ratings. When you see a row home, when we're shopping a row home, there's a lot of carriers charge a little bit extra for a row home because there is that added exposure. So, the actuaries, the people who are setting rates for the insurance carriers are, pretty smart people, and they kind of can factor that in and say, we see, pretty empirically, we see, X percentage more claims for row homes in this area than we do for freestanding, and we have to rate and collect premiums accordingly. But yeah, to kind of long answer to your short question, yeah, everyone's own insurance covers just their own property, no impact on, your neighbor's property or anything like that.
And I guess that's where it kind of starts to get confusing, especially when you start to get multiple properties. You're a real estate investor, and it helped talking to you, and how you run your portfolio to understand. We've gone from everywhere from individual policies to a master line back to individual policies with you. And there's the liability, there's the property level stuff. There's all this different stuff inside of your policy. I guess as a professional real estate investor or someone who owns more than one house, is it better to have a master line or individual policies? What's the difference? What's the exposures? How can someone be exposed if they have one policy or the other?
Sure. So generally, we will always recommend doing individual policies whenever possible. So if you have 10 single family homes scattered out, a city or multiple cities, we'll always recommend doing individual policies for each one. Couple reasons for that. Number one, you're essentially multiplying your liability limit. If you're on a master policy, you have those 10 homes on a single policy, all subject to one liability limit. So if you have a couple bad claims, you can essentially exhaust that liability limit, and for the rest of the year, effectively leave no liability coverage on the rest of your portfolio. So with individual policies, you have an individual limit for each property. So one property bad claim won't affect the other one. So there's a little bit of a diversification of risk there, which is incredibly valuable. The other thing too is if, say, you have a bad claims year, or say property claims, and you have 10 properties listed on a single policy, and you have 3 property claims, the carrier might come back at renewal and say, you know what, we're losing too much money here. We don't want to write this anymore. We're going to cancel your policy effective at your renewal date. At that point, you're stuck shopping 10 individual policies, all now with cancellations in their account histories, which is going to skyrocket anytime you try to shop with another company. So we'll always try to recommend just diversifying whenever possible from doing just like a single master policy versus individual.
Yeah, that makes a lot of sense. I know we titled this podcast Insurance 101, but I think we should maybe get a little bit more advanced on some of this stuff, because I mean, listen, I work with a lot of real estate investors. Ian owns a lot of properties. I'm sure you work with a lot of investors, and just nobody takes it seriously. They always have the wrong policies in place. They don't understand. They get pissed off. They just have to pay $1,200 for a 6-month builder's risk policy, and they just don't even realize. I mean, I couldn't tell you how many loans I've done for borrowers that it's the day of closing and they have a landlord policy in place. And I'm like, that's not going to cover you if you're doing construction. Like, if it's burning money. Number one, we won't approve you to close with that. But more importantly, it's a waste of money. They're going to just not, you might as well not have insurance. But anyways, real estate investing is a little bit of an unregulated business model in general. So typically there's not really like E&O insurance and things like that. Is there any alternative insurance policies that can be creatively structured for real estate investors? Maybe somewhat like an E&O. And I can give you some more examples because we've put policies together for our lending company, and they're typically secondary writers that we kind of had to collaborate on putting something in place. But if you're a real estate investor, it's not just the property that's protected for insurance purposes. You might be raising capital from an individual investor that might want to sue you. You might sell one of your properties to another owner, another buyer, and they might come back and say, hey, you told me this was renovated and now I'm running into all these problems. I'm going to sue you. There's always lawsuits. I mean, anyone can sue anybody for anything. So is there, like you said, related to that, water was dripping down the hill and went on to someone else, and maybe that person doesn't have insurance, right? So they're saying, this is on you. No, this is on you. Well, I don't have insurance, so we're just going to sue you and see what's up. If anyone who's been in real estate long enough has been sued or, has come across this. Is there alternative insurance policies in place for some of these particular items?
So, yes and no. I mean, it kind of depends on the individual and what specific risks they're looking to cover. So, like, the easy answer is there's a market for pretty much everything in the insurance world. And if your heart desires it, someone will, you'll be able to find it for you and make it for you. Really, kind of the only alternative, that's more commonly seen rather than like property liability coverage, would be like an errors and omissions policy. And we more see those with the larger landlords, certainly property management companies. Whereas like if you decline someone's application, they sue you for discrimination. There's a layer of coverage there to kind of protect from that. But that's on that errors and omissions spectrum. So we will see that certainly for, like, again, larger real estate investors, but someone just buying their first couple of properties, it's not really a major concern. And there's a lot of stuff you can kind of do to not in the insurance world to kind of alleviate some of that risk. Just having good processes and procedures in place to kind of eliminate discrimination claims and things of that nature. Yeah. There certainly are kind of like alternative products, more so than just the liability and property portion. But there isn't really a blanket recommendation I would make just to, like, the general listener. I would say that we look at each individual situation just like we do with every client, and see if there's any kind of gaps in coverage or something that we might recommend based on their operations.
Sure, and I know typically it's probably because it's just too darn expensive for one person who buys one property to spend 10 or 15 grand a year on a catch-all policy. Just doesn't work economically. What can somebody's individual, like, personal umbrella policy overlap for some of those things?
Generally not. So generally, like, your umbrella policy is specifically just for general liability, which is you basically causing injury to a third party. Any kind of like contractual obligations, things like that, those are more on that errors and omissions spectrum.
Got it. Yeah, so I know a guy, me and Jason actually know a guy, and I think I talked to you about this before, Ryan, is they actually almost self-insure they jack their deductible up, and then they buy an insurance policy to protect against their deductible because they never make claims. And he's like, if I can save X number of dollars over this many years, you start to self-insure. And it's something that we talked about, and I think it goes to Jason's question of like having mainline insurance. At our size portfolio, spending $50 a year times X number of properties times how many times we're going to replace that. When do you start to see things that you should self-insure, maybe as a cost savings benefit to real estate investors?
Sure. So I think it comes down, number one, to each individual client, their risk tolerance. If it's their first rental property, we might want to put on more coverages. And if their funds are tight, we might want to put on a little bit more coverage to protect them from those catastrophic, effectively catastrophic for them occurrences. If you have one property and you have to put in a $15,000 sewer line, it might be a good idea to spend a couple extra bucks a year to put on that service line coverage. However, at scale, ultimately you want to start scaling down that stuff for exactly what you said. If it's going to cost you another $50 or $100 per year times 50 properties, just as long as your sewer line and it doesn't break in 3 years, you can put on a brand new one from your premium savings. And if it doesn't happen, you kept that money in your pocket rather than putting it in an insurance carrier's pocket. So, we always tell our clients, you're better at spending your money than an insurance company can spend it for you. So whenever you can self-insure and you're comfortable doing so, you absolutely should. And part of that too is like the deductibles as well. If it's your first property, you probably don't want to go higher than $1,000, but you have 15, 20, 50, properties. It's definitely something you want to consider going up, because ultimately that annual premium savings, should you have to pay a $2,500 deductible versus $1,000, you pull from 3 months in premium savings. So again, it's not really like a blanket recommendation I would make for every real estate investor. I would say it's we certainly look at every client, and kind of make a determination and chat with them and figure out their risk tolerance. And other brokers should do that as well. And kind of just take it on a case by case basis. And that's kind of the benefit of working with a broker or an agent who's familiar in the field, because they're going to be able to make those better recommendations for you.
Yeah, that all makes sense, guys. We're gonna have Ryan on here for a few more minutes. So if you guys any questions, just pop them in the comments. I do want to ask you one more thing, especially since Jason's on here with us and he's a private lender. I borrow a lot. I always get that, you need to increase your insurance limit, blah, 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 blah. You need to meet lender requirements, whether it's a hard money lender or a mortgage lender. What's behind all that? Is it more about replacement costs, loan coverage? Like, is there something you could look out for to, keep your costs down in that sense? On a small single family house, not a huge deal. Start levering up into a few $1 million apartment building, storage, industrial, it could cost you a few bucks.
Yeah, so we'll always recommend full replacement cost coverage. And again, what that is the carrier is contractually obligated to rebuild that house exactly like it stands, just brand new. Lenders are holistically always okay with that limit. Occasionally, we might have to show the calculation of how the carrier derived that limit if the replacement cost comes in less than the loan amount. But like the example I'll give you is like if there's a single family home in where I live, Bethlehem, Pennsylvania, and it's $200,000, the replacement cost might be $350,000. If that same house is in Manhattan, it might be a little bit higher, but the market value or the loan value could be 10 times that if it's a single family home on an island in Manhattan. So with those cases, you'll see it where the replacement cost is significantly less than whatever the loan amount is. But what would happen in a total loss, and the lenders are all okay with it, is you would just rebuild the home just brand new. And if you didn't want to live there anymore, you would just sell it for whatever that market value is, $5 million or whatever real estate in Manhattan is these days. So you'll kind of see it both ways, but generally when working with lenders, we always want to do that full replacement cost coverage, and by and large, they're always okay with that. A lot will kick back if it's actual cash value, because they know that in a loss, they're not going to get enough to rebuild. probably not going to cover the loan amount, and certainly not enough to go buy something comparable. So lenders in 9 times out of 10 are always going to require that replacement cost coverage, and they're always okay with it when we list it with that full replacement cost coverage and justify it if we need to.
Can you even do your policy higher than a replacement cost? Meaning, like, let's say the replacement cost, and obviously, like, one of the big reasons why, that comment you're just talking about is land value, right? Like, if it costs $250,000 to replace a house on land that's worth $0, it's $250,000. But in Manhattan, the land might be worth $2 million. So that's why it's $2 million.
Sure. And yeah, that's kind of where that like market value is a little bit different. That house, that $200,000 house that would cost to rebuild, anywhere, for arguments purposes, might be $300,000 in Pennsylvania or $5 million in New York, but that insurance would still be for that $200,000.
Can you do a policy? Can you write it for $2 million with a 250 replacement cost, or no?
Nope. So, and a majority of that reason is to protect from insurance fraud. So if you buy a house for $200,000, and it's $350,000 to rebuild it, you can insure for $10 million, and magically one day it burns down and you go cash your check for $10 million. There's certainly a lot more fires than there are, mysterious fires, I should say. So always replacement cost. Now we can inflate it slightly if maybe the client feels it's not encompassing maybe some like custom upgrades, things of that nature, or maybe the square footage that's pulled from the tax records, maybe there's been a addition to the property or something, and we can inflate it for those. But arbitrarily just inflating it, no, because effectively you'd just be paying premiums on $10 million, and contractually the carrier don't rebuild your house, so net total loss are just going to rebuild it for you. No extra bonus on top of that.
Yeah, and going back to what Ian said earlier related to us as a lender, I mean, we usually want to do loan, whatever our loan amount is, to make sure that's covered. But also that works, Ian, typically because we're in median housing price neighborhoods. So typically the loan amount's usually less than the replacement value in a lot of these cases. I mean, if the loan amounts, most of these loans are $150,000, $250,000. So it works in that. It works in that. Like, I don't think we probably have ever done a deal, at least that you were involved in, that we lent money on that the replacement cost was lower than our loan amount.
Yeah, and you'll see that for a lot of rental properties. They're typically, by and large, older homes. They're probably solid masonry walls or a solid masonry construction, plaster walls. So the replacement cost has to rebuild for an account for that. Whereas like a lot of new construction homes, just stick built vinyl siding, you're going to see those replacement costs and market value a lot closer than you will with like your average row home rental property. Sure. And then so yeah, you'll definitely vary by year of construction, type of property, all that stuff. So
yeah, and me and you, we had I feel bad because I ran you through the ringer, but third, fourth insurance agent, again, it's like, I just don't understand, and these are all the ins and outs that, like, I don't think a lot of people understand. And we're like, well, how can the replacement cost be this? And then, like, we send it off to our lender after we sign the policies, increase this one, decrease that. And it gets so confusing. And it's just like, all I know is just want to insure it. God forbid the goddamn thing blows over. That's my view on it. And, we go out there, a roof blows off 9 times out of 10. I'm going out there fixing the roof, and that's it. Like, I don't put a claim in. I keep it moving, and it drives me up a wall when we pay all these premiums because I literally only protect a catastrophic loss. Like, that's what I want to protect against.
Yeah, but also there's an argument of what the replacement value is. Who's replacing it, right? Somebody who's handy, who has connections like you, Ian, or some passive bank that doesn't want to get their hands dirty on it. So, like, there's definitely an argument besides that, and that's why I think a lot of the banks, including ourselves, want to make sure, it's you have the ability to, and listen, as soon as you get into a what's that called, irrevocable proceeds, a two-party check or whatever, to go, a house burns down or whatever, and they have to go clean it up, and they don't want to pay off the lender type of situation. That's a freaking nightmare.
Yeah, and that's where I was beating up on Ryan. I'm like, well, why can't we lower the replacement cost? Because we do have that mental disconnect of like, well, then what? And it's not like, oh, here's if you got whatever 1,000 feet at $125 a foot, they're not just handing you a $125,000 check, right? They're going to replace what was there. It's not like you're pocketing cash. And then the other thing is, if it costs $200,000, there's also positions in that policy, if I'm correct, Ryan, that if code is changed, they're also going to protect you in that sense that you're not going to be out of money, right?
Yeah, so generally every policy is going to have increased law and ordinance coverage, what they call it. So if maybe if when the house was built in 1900, there was I don't even know if there were sprinkler systems back then, but maybe if it burns down, now all new construction homes have to have a sprinkler system. That's typically encompassed in the increased cost of construction for that law and ordinance. Yep. So
it all makes sense, and I think this is where it comes down to. Me and Jason are going back and forth. We're like, all right, I got one more, because insurance is just like one of those topics, and it just never stops. What I was about to say, and Jason cut me off before I go into the story.
One more question that I think a lot of investors don't know. After you write an insurance policy, is somebody doing physical inspections of the properties?
It depends. Some carriers, no, they'll put everything on the agent and have, have us basically do all the underwriting. Some will, just look like after binding, might just look at Google Maps and make sure the roof's still on. Some will physically go out. Generally, no company will go in properties. That's pretty rare. Used to be rather common, but now it's actually like really rare to have a insurance carrier want to do like an interior inspection. But those certain ones will certainly, go out and take a walk around the outside, make sure the roof's on.
Yeah, because I don't think a lot of investors realize that. And I'll tell you, a shady practice that I knew a lot of investors used to do, which obviously I don't recommend doing. And if you're using us as a lender, you can't do it. But I know a lot of shady investors they'd be doing these fix and flips so quick, so they'd be getting some sort of landlord policy in place just to suffice. And they knew that, because it was half the price, and they knew that within 30 days they would have to do some sort of inspection. And as soon as the inspection came back, they could be like, oh yeah, we just had to do some of this, and they talk their way through. They could talk their way through it. Like maybe they were going to turn into rental properties to begin with, right? Mm-hmm. But they were also doing $100,000 renovations, and they were flying through them as quick as possible. And then they were just kind of negotiating with the insurance company after the fact. Just so they can have a policy that
I always think it's a risk reward. Like I just bought a property in December and it was unoccupied, and I'm rehabbing 2 of the units before I rent it out. And personally, it sucks to pay. I think the policy is like $800 versus for 3-month policy term versus maybe that for the year for an occupied policy. But should I have a fire and that's $100,000 loss or $200,000 loss, whatever it is, I'm going to be really glad I paid that extra couple $100. It's tough because some people get really hung up on price, and we have some here you live by price, you die by price too. So it's you don't want to risk such a big loss for such a relatively small amount of additional capital to be covered correctly.
Yeah, and that brings us, with a kind of like a final story. Jason had a complete fire loss. We won't name the vendor. I think it's important that something that Jason, and he can explain way better, is they cut him a check 5 days later on site. Like, here you go. It was done from fire to check. What was it, like 5 days or less? Something insane like that. And I think that goes, even though you're going with a broker such as Ryan or whoever you so choose, is that you're getting underwritten with not even admitted or not admitted, just a reputable carrier. Jason's probably got another horror story where didn't you have to fly to Utah and go, try to fight for your money? I guess as you, Ryan, Ryan, you as a broker, I don't say not how we can trust you, but how do we know that you're here's 4 quotes? How do we know that they're a company that's going to pay when we have a claim and there's not going to be issues and they just want to do what we're trying to do and get the job done?
Sure, and I mean honestly, it's a constant topic that comes up for us when we're shopping for our clients, because a lot of times, I mean, we have a lot of markets, so we're always really pretty ultra competitive on pricing and coverage, frankly. And it comes up a couple times a year where someone's like, "This is too good to be true," and like from our perspective, it's like a silly argument, because number one, we wouldn't be in business very long if it were too good to be true. And insurance is probably the most heavily regulated industry in existence, at least in my opinion, probably even more so than financial services. So for like, when sometimes we say, well, will this company pay my claim? Well, yeah, of course they would, because there's so much regulation. Most of the carriers are backed by the state that they're domiciled in. So it's never a question of if they're going to get paid or not for something that should be a valid claim. I think the difference is maybe the size of the company and kind of their experience in claims handling. We only want to work with like the tier 1 companies. So there's a company called AM Best. It's like a credit score for insurance companies. We only work with A-rated markets. And we do a lot of our own internal vetting too, to see what their claims turnaround time is, their customer service is. Because what I don't think a lot of people really connect is that our interest from the insurance agent and the client were completely aligned, because especially for my individual business, we don't do any advertising. We do everything that comes in the door is a referral base. So if we would ever put a client with a carrier that somehow theoretically wouldn't pay a claim or is going to give them a hard time, that's bad for me too, because we don't really get any new clients and we can't grow our business. So we put a lot of pride personally into making sure we're only writing with the best of the best companies that are going to handle claims and
Right. Ryan froze up again, but I can go through a success story and then a horror story to justify and attest to what Ryan was just talking about. So the success story was, a big insurance carrier on the fire day. You still there? Cool.
Yep.
Okay. I don't know if you just heard what I said or not about attesting to making sure it's a good carrier, but I can say a success story and then I can say a horror story for one of each real quick. So that fire damage property Ian was talking about was with a big carrier that paid us out in 5 days. And listen, it was unfortunately it was in a not the most high-priced area of Baltimore City, and they paid us off replacement value, which was significantly more value than the property was worth resale-wise. And we didn't want to rebuild it, so they were willing to just write us a check for it. And they realized it was they investigated. They realized that the tenant in the property had caused the fire and things like that. So I know insurance companies don't like to lose money, so I know for a fact that after they paid us out, they went to probably sue the tenant. The tenant's policy and anybody they could to try to recoup as much funds as they could, right? But that was one success story, right? With a good carrier. On a horror story, which is the story Ian's talking about, when we had to fly out to Utah to sue this shady insurance company, it was a third tier, or maybe even worse. I don't know how low tiers go of insurance, but the property had already had 3 fires when we came in for the loan, so the guy couldn't get good insurance. And at that, and let me rephrase a little bit. We did a loan, and then the house burned down with one of his insurance companies, and then it was rebuilt, and it was burnt down again, and then he went into the default, and we were paying $30,000 a quarter just to keep insurance in place, and we couldn't move it to another carrier because it went with the property, and we weren't the owners, the other guy was. So it was a shady company, and the house burned down to the ground. It was a 15,000 square foot house, and the issue was the fire marshal wouldn't write up a report related to the findings of the house. There were signs that it could have been arson. Then they went back to the application that the buyer put, and he said there were sprinkler systems in there, and there might not have been sprinkler systems in there, but no one proved that they were. They weren't because the fire marshal didn't want to put his name on his neck on the line for it. So it was a crappy situation, unfortunately. And not that they declined the claim, but they said, hey, until you give me a fire marshal report, we're not going to pay out the claim. And the fire marshal says, okay, well, we're not putting together this. So we had to be proactive and go sue them. And, we ended up being made whole for the most part. Not everything, but at least principal of the loan. But the issue there was, like you were saying, as long as it's an A-rated or a reputable company, they'll pay it out. what actually helped us win our case is there were lawsuits against the company that stated that they were a high risk carrier and they were known for taking big premiums and not paying out cases. So that actually helped us in court. And unfortunately, we didn't really have a choice in that case because I couldn't control the insurance. We were already in the midst of the loan. We just wanted to make sure the guy had insurance in place. But it attests to what could happen if you don't have the right policy in place. Because let me tell you, when you go and sue an insurance company, let's just say it was multiple six figures in legal costs.
Yeah, I'm sure it was.
Well, I hope no one has to sue anyone. Ryan, how can we find you so you're properly protected and you don't need to go out and sue?
Sure. Yeah. So, anyone, if they're interested in having us take a look at their portfolio, give us a call or shoot us an email, just Brian@redrabbitinsurance.com, or just Google Red Rabbit Insurance. You'll see all our contact information there. And yeah, anyone who's, even just wants advice, we don't necessarily have to shop anything. If you're just curious, or new investors or experienced investors looking, have their stuff reviewed, that's, right in our wheelhouse.
Yeah. And type in Bethlehem, right? Like you guys are out of Bethlehem, Pennsylvania.
Yep. That's our home office. It still should come up with Red Rabbit Insurance. I don't think there's too many companies with that name. So.
Fair enough. Well, we appreciate it. We're actually getting ready to release a new network that we're going to do a small beta test on. Hopefully you can join, and we're literally about to release it now. So we're going to let you go, and maybe you can join that network and be able to comment and interact with some of the real estate investors and help them out, man. We really appreciate your time.
Yeah, absolutely. And thanks for having me on the show. I really appreciate it, guys.
Thanks, Ryan. Appreciate it.
Thanks, Ryan.
Good. Yeah, man. Like you said, I think insurance is sexy. I like talking about it all the time, and people think it's crazy, but it's like, I want to make sure we're properly protected. We have a lot of assets.
I was happy to talk insurance just because Ryan wasn't wearing a suit. So I was like, all right, I feel comfortable.
Yeah, here's Ryan's email address. I'm just going to post it on the screen. And Ryan, if you're still listening and you want to comment on this feed, you can do that as well with your contact information. So, hey, everybody, let's talk about a new platform and a new network that Ian and I and both of our partners, my partner Chris and his partner Dan, kind of have put together recently. We have it in beta. I'm going to announce it here in a second, but one of the reasons that we decided to create this network is I feel like all of us are sick and tired of going onto Facebook how many groups are there in Facebook? Baltimore, DC, Philly market. There's all just subgroups of wholesaling, flipping, deals, self-storage, everything. And there's like Baltimore Investor Group, Investment in Baltimore Group, single family group, whatever the case is. And there's 10, 20, 30, 100 different subgroups, and people are just posting the same things over and over and over. And I know a lot of people go on Facebook and spam stuff. So we decided to put together a network and like a real community of real estate investors that was free for everybody. So instead of doing everything through Facebook, we can all do it through this network. Nothing to sell, completely free. That's what it is. But it's got a hell of a lot more capabilities and features than Facebook has.
Yeah, and it's nice to get onto a network and consume the content you want, right? Like cancel culture is big right now, and you go on Facebook and there's all this other noise until you find exactly what you want. Well, you know what? Cancel everything and watch what you want to watch, and it's all about real estate here. Every asset class, every topic, even some, personal development type stuff. We're excited to release it. Like Jason said, it's a beta test before we go and release it to everyone else. But we're working through small things. We want your feedback. This network's for you guys, for us, for everyone involved, a place that we can have a sense of community and talk about real estate investing and be able to share different ideas. And one of the cool things is everyone from REI Madness, we're going to bring them in as well. We'll be able to contact everyone, all the people that come on our show. There'll be ways to access, just like having Ryan on here, rather than have to go find him on Facebook and everything else. He'll be right here in this network. So we'll do a quick screen share, REINetworks.com. Jay, you want to go through it? I know you spent more of the time building it out. So, you show everyone the different features around here. We got
So for instance, it's through a platform that's completely mobile friendly. You can do it on your phone. You can do it on your computer. More importantly, it's got an app. So after you'll be able to see how, after you log in, you can download the app, and that has notifications, and you can, you don't really even need to do it on your computer. Just do everything on the app. Hang on one second.
Here's my favorite picture right here. I don't have a beard, and you look great.
Within it, I was thinking about this. We put all of our podcasts that we did over the last year on there, and we went from long hair to short hair to big beards to tan to pale. Shit changes in a year. Different office backgrounds and shit like that. So, but here's the thing: you can go through any of these feeds, watch videos, do topics, anything you want, whenever you need to, quickly. That's easy. If you want to comment or post or anything like that, you have to join. It's free to join; doesn't cost you any money, but you do have to sign in and join. So all of the podcasts that we did are natively in there. Like click on wholesaling, for instance. So that's everything in there related to it. Obviously, we're all going to collaborate. We're all going to put content in there collectively. We just started. We wanted to do this in beta. You guys are the first ones of hearing this right now. So there's no other members on here right now except us. And our business partners haven't even joined yet, but they will soon. So all the meetup groups are going to be hosted inside this platform now. So if you go under Eventsian, you'll see that the meetup groups are in there. You can RSVP. Right now, we haven't launched the topic yet for the most upcoming one, but we will. So it's just a good home base for real estate investors. Sorry, it's a home base for real estate investors and real estate professionals. So if you're a real estate investor, if you're a real estate agent, if you're a real estate appraisal, if you're a title company, an insurance company, a attorney, anything related to real estate, and you provide value, you do it. Now, obviously, we don't want to turn this into a deal spam fest where so many people out there just posting. Like we've used platforms like this for other things that Ian and I are associated with. Real communities of like-minded people, and this is a good platform to do it. And not that Facebook isn't, Facebook groups don't work, but there's just so much more functionality on this. And instead of having to go into multiple groups and multiple feeds and multiple everything, you can just hop onto this and access everything. So, Ian, again, go to topics. So everything's categorized kind of in topics. So you can let's say you're interested in self-storage, you can watch, or multifamily or whatever. You can watch some videos related to self-storage. We're going to continue to add some in there. And then let's say you want to type. Ian's not signed in, so he.
So here's the other thing: you can follow these exact topics because as the feed on the main page starts to get more busy, you'll be able to see specifically the wholesaling stuff, and eventually we'll start to build out groups and some other things. And then if you just want to, you can sign in with your Facebook, so you don't have to get junk email from us. And there you go. Now we're in, and I can. Jason said LFG. Let's do it. And you can post your topics, and it's multi-family question. Maybe I'm doing this wrong. That's the topic. Problem is I'm in the damn main one. So you guys can just post right here and quick post, and you put your information, tell me about multi-family, and then you can add the topic right here. So it's connected to multi-family, and boom, there you go. And we post. So,
but ask a question real quick. You know how to do that?
Let's see. Quick post or questions? Yeah,
here, I'm going to ask a question on my phone because everything, the mobile capability is what's really, really cool about this. So, logged in here, I'm just going to click ask a question.
Question or poll? There you go.
So let's see. Ask a question like, how do you find deals? Whatever it is, right? Post. You can add a topic or not add a topic. Okay, go now, Ian. Don't notify. Here, now go to your home screen. Don't notify. All right. Ian's got it hijacked, so let him do his thing. Go to home real quick. There you go. There's my question right there. So go down. So then you can ask a question and the whole community will share it with you.
There you go. So, no, it's exciting. I know these tutorials aren't the most fun things in the world, but you guys will see as more people start to join, and we get through this beta, and we, give us feedback, please, and we'll continue to build this out and continue to grow it. So it looks like Mike Kuzer is the first one to join, which I think he was just watching. Awesome, man. Shoot me a private message and send me your address, and I'll send you a copy of my book if you don't have one yet, and I'll get Jason to send you a copy of his book. And thanks for joining, man. Appreciate it.
Hi, guys. I hope you enjoyed this episode of the Real Estate Reserve podcast. Definitely share this REI Networks with everybody. Again, like we said, we haven't shared this with anybody publicly yet. Our business partners don't even have an account yet. So it's really new. We weren't even going to really talk about it on this podcast, but you know what? Screw it. No better time to go live and to take action than right now. So even though it's not fully done yet, we still did it, and we don't like the logo, FYI, and there's new logo revisions coming this way. So we like to take action. That's always something that's important to us. So cool, Ian. Anything else to add before we hop off?
No, it was a great episode. Insurance, REI Networks, let's do it. I got to pee. These hour-long episodes are perfect timing. I'm out.
Thanks for tuning in to the Real Estate Reserve podcast. Do us a favor and like, comment, and share our broadcast. It helps the algorithm and helps us spread the word too.